The year is 2005. In a small office in California, far from the gleaming towers of Wall Street, a single lamp cuts through the darkness. The room is almost empty. No decorations, no distractions, just stacks of documents piled on a desk and a man sitting alone, reading. Michael Burry flips through page after page of mortgage bond prospectuses. His eyes scan the numbers with mechanical precision. Hours pass. The pile of documents grows smaller. And then, something changes. He goes back, reads again, checks the numbers a third time. The expression that crosses his face isn't confusion, it's horror. Pure, absolute horror. Because Michael Burry has just discovered something that nobody else in the entire financial world has noticed. The American housing market, the safest, most stable investment in the world, the foundation of the entire economy, is a fraud. And he's about to make the biggest, most insane bet of his life. He's about to bet against everything, against the banks, against Wall Street, against America itself. But why? The housing market was booming. Prices were climbing every single month. Everyone was making money. It seemed impossible that it could fail. So what did he see that nobody else did? Chapter 1. The Discovery. Michael Burry wasn't looking for a conspiracy. He was just doing what he always did, reading, analyzing, looking for opportunities that others missed. As he dug deeper into these mortgage bonds, but something didn't add up. The documents he was reading contained thousands of individual home loans bundled together and sold to investors as safe, stable investments. These were called mortgage-backed securities, and they were everywhere. Banks loved them, investors loved them, the ratings agencies gave them their highest ratings, AAA, the safest investment you could make, right next to US Treasury bonds. But Burry saw something different. He saw loans given to people with no jobs, loans given to people who couldn't possibly afford the payments, loans with interest rates that would explode after 2 years, turning affordable payments into financial disaster. And these weren't just a few bad loans mixed in with good ones. These bonds were packed, absolutely stuffed with garbage. Let me explain this to you because this is where it gets absolutely insane. And I'm Dagon, by the way, and you're about to understand exactly how the entire system lied to everyone. Think about this. Have you ever had someone you trust, maybe a family member, tell you that an investment was safe, that it was a sure thing, no risk at all, and then you found out later they were wrong, or worse, they knew it was risky but told you it was safe anyway? That's exactly what happened here, but on a massive scale. You see, mortgage loans have ratings. They're classified based on how likely the borrower is to pay them back. At the bottom, you have subprime loans. These are loans to people with bad credit, no steady job, people who are extremely unlikely to make their payments. These are rated B or double B at best, high risk. At the top, you have prime loans, AAA. These are loans to people with great credit, stable jobs, people who will almost certainly pay back every dollar on time. Here's the trick. The banks and the ratings agencies took those garbage subprime loans, the ones that should have been rated double B or single A at best, and they called them AAA. They labeled them as super safe premium investments, when in reality, they were ticking bombs. They convinced people that they could afford homes they absolutely could not afford. They handed out loans without checking income, without verifying jobs, without requiring down payments. And then they packaged all of that disaster into neat little bonds and sold it to pension funds, insurance companies, foreign governments, telling everyone, don't worry, it's AAA, it's safe. Now that you understand this, you can already see where this is going, right? Burry sat back in his chair. The lamp flickered slightly. The office was completely silent except for the hum of his computer. He'd just uncovered the largest financial fraud in history, and nobody knew, nobody cared. The entire world was celebrating the housing boom while the foundation was rotting underneath. Most people would have walked away, reported it maybe, warned someone, tried to get out before the collapse. But Michael Burry wasn't most people. He was going to bet against it, all of it. He was going to short the housing market. And if he was right, he'd make a fortune. If he was wrong, he'd lose everything. Chapter 2. The Bet. Burry started making phone calls. He called the biggest banks on Wall Street, Goldman Sachs, Morgan Stanley, Deutsche Bank, and he told them what he wanted to do. He wanted to buy credit default swaps on mortgage bonds. The bankers on the other end of the line were confused at first. Credit default swaps were basically insurance. You pay a small premium every month, and if the bonds fail, the banks would pay you massive amounts of money. But nobody bought insurance on mortgage bonds. Why would you? Housing never goes down. Burry explained that he wanted to buy billions of dollars worth of this insurance. He wanted to bet that the housing market would collapse. The bankers laughed. Not out loud, of course, but you could hear it in their voices. They thought he was insane. And then they said yes. Why wouldn't they? From their perspective, he was handing them free money. He'd pay premiums every single month, and the housing market would keep going up, and they'd collect his payments forever. It was the easiest trade they'd ever make. They had no idea they were sealing their own fate. But here is where it gets interesting. Burry wasn't the only one who saw this. In New York, a man named Mark Baum was starting to ask questions. He ran a smaller fund, and he was suspicious. He'd seen the mortgage brokers, the predatory lending, the lies being sold to families who didn't understand what they were signing. In the back offices and quiet corners of the financial world, a few others were starting to notice the cracks. But none of them had Burry's conviction. None of them were willing to bet everything. And that's because Michael Burry wasn't just smart. He was different. This is the moment you need to understand who he really was. Michael Burry had Asperger's syndrome, a form of autism that gave him an incredible ability to see patterns, to focus with absolute intensity, to ignore social pressure and trust only the data. His entire life, he'd been an outsider, socially awkward, misunderstood, but he'd learned to rely on one thing: his mind. He didn't care what people thought. He didn't care about fitting in. He'd built his hedge fund, Scion Capital, on his ability to see what others missed, and he wasn't going to let anyone, not his investors, not Wall Street, not the entire world telling him he was wrong, make him abandon what he knew was true. He'd read the documents, he'd done the math. The housing market was going to collapse, and he was going to be ready. So let me break down what a credit default swap actually is, because this is the weapon Burry used to fight the banks. Imagine you own a house and you're worried it might burn down. So you buy fire insurance. You pay a small amount every month, and if the house burns down, the insurance company pays you the full value. A credit default swap is the same thing, but for bonds. Burry was paying the banks a small premium every month, and if the mortgage bonds failed, the banks would have to pay him the full value, millions, billions. The banks thought they were selling him worthless insurance, but Burry knew he was buying a lottery ticket, and the drawing was coming. Knowing this, the real question becomes, what happened next? Burry signed the contracts, billions of dollars in credit default swaps, and then he waited. But the market didn't collapse, not right away. In fact, it kept going up. Housing prices climbed higher, more loans were given out, more bonds were sold, and every single month, Burry's fund bled money. He was paying premiums on his swaps, and the bonds weren't failing. His investors started to panic. Month after month, the losses piled up. Tens of millions of dollars just disappearing, paying for insurance on a collapse that didn't seem to be coming. And then the phone calls started. The investors in Burry's fund were furious. They didn't understand what he was doing. All they saw was their money vanishing. They demanded meetings, they sent lawyers, they threatened to pool their investments, to sue him, to destroy him. Burry sat in those meetings, quiet, awkward, trying to explain the data, but they didn't want data, they wanted their money back. One investor stood up, yelling, red-faced, "You're gambling with our money. The housing market has never gone down. You're insane." Burry stared at him, didn't flinch, didn't argue. He just said, "I've read the bonds. I'm right." And he was. But being right doesn't matter if you run out of money before the world catches up. This was the loneliest moment of his life. Everyone thought he was crazy. His investors hated him. Wall Street mocked him. Even the people who worked for him started to doubt. But he didn't quit. He couldn't, because his entire life had been like this, being the outsider, being misunderstood, trusting his mind when everyone else told him he was wrong. He'd gotten this far by ignoring the noise, and he wasn't going to stop now. And then, in early 2007, something changed. The first cracks appeared. A few subprime lenders went bankrupt. Small companies, nothing major. The news barely covered it. But Burry saw it. The defaults were starting. Then more lenders failed, bigger ones. And the ratings agencies, the same ones who'd labeled everything AAA, started quietly downgrading bonds. Burry watched his computer screen. The value of his swaps started to climb. He was right. Here's why this mattered so much, and why the collapse was inevitable once it started. The financial system is like a house of cards. Every piece is connected. When you have banks lending to people who can't pay, and those loans are packaged into bonds, and those bonds are used as collateral for other investments, and those investments are leveraged 30-to-1, everything is balanced on everything else. So when the bottom pieces start to fall, when people start defaulting on loans, the entire structure comes down. One bank fails, and it can't pay another bank. That bank fails, and it can't pay its investors. Those investors panic and sell everything. Prices crash, more banks fail. It's a domino effect. And once it starts, you can't stop it. With this in mind, let's see what happened next. By the summer of 2007, the collapse was undeniable. Bear Stearns, one of the biggest investment banks in the world, had 2 hedge funds completely wiped out, billions of dollars gone. The subprime mortgage market was imploding, foreclosures skyrocketed, families were losing their homes by the thousands. And Burry's credit default swaps, the ones everyone said were worthless, were now worth a fortune. Other investors who'd made similar bets were cashing out, taking their profits. But Burry held on. He knew it was going to get worse. And it did. In March 2008, Bear Stearns collapsed entirely. It was bought out for almost nothing by JP Chase. In September 2008, Lehman Brothers, one of the oldest and most respected firms on Wall Street, filed for bankruptcy, the largest bankruptcy in American history. The stock market crashed. The global economy teetered on the edge of total collapse. Governments had to step in with trillions of dollars in bailouts just to keep the system from disintegrating completely. And Michael Burry's fund made over $700 million. He'd been right. He'd bet against the entire world, and he'd won. Chapter 4: The Fall and the Aftermath. But winning didn't feel like victory. Burry sat in his office, watching the news, the same office where he'd made the discovery years earlier, the same lamp, the same stacks of documents. On the screen, families were being evicted from their homes, people were losing their jobs, retirement savings were wiped out. The global economy was in ruins. He'd made a fortune, but millions of people had lost everything. The banks that had sold him the credit default swaps, the ones that had laughed at him, were now begging the government for money, and they got it. Billions in taxpayer-funded bailouts. The executives who caused the crisis, who packaged the fraudulent loans and sold them as safe investments, faced no consequences, no arrests, no trials. Most of them kept their jobs. Some even got bonuses. The system had failed, and the people who broke it were rewarded. Burry closed his fund shortly after. He'd proven his point. He'd made the bet of his lifetime, but the victory was hollow. Because the real question wasn't whether he was right. The real question was, why did it happen? So here's what we learned from 2008, and this is important. The crash happened because the system was designed to reward short-term profits over long-term stability. Banks made money by giving out loans and selling them immediately. They didn't care if the loans were repaid because they weren't holding them. The ratings agencies were paid by the banks to rate the bonds, so they had no incentive to be honest. And the government regulators who were supposed to be watching either didn't understand what was happening or didn't care. Everyone was making money, so nobody asked questions until it all fell apart. And the people who suffered the most weren't the bankers or the executives. It was ordinary people. Families who'd been lied to, workers who had lost their jobs, retirees who'd lost their savings. The banks that caused the crisis got bailouts. The people who were victims of the crisis got nothing. That's the system. And the scariest part, most of the problems that caused 2008 still exist today. The banks are bigger, the leverage is higher. The same risky behavior is still happening, just with different names. Michael Burry saw it coming once. He spent years after 2008 warning that it could happen again, and very few people listened. The lamp in Burry's office flickered one last time before he turned it off. He'd won the bet, but the game was rigged, and it still is. The question isn't whether another crisis will happen. The question is when, and who will see it coming this time.